Okay, thank you very much. Hello, everyone. I'm here to give you a brief overview of Dodge Cox and an update on our global stock fund. So to start quickly on Dodge Cox, we're based in San Francisco. The firm now has a little over 450 billion in assets, as you can see on the slide here. We are fairly concentrated in what we do. Money management is our only business, and we invest only through 7 funds. So we have 1 U.S. stock fund, 1 global stock fund, and so forth, as you see here. Most importantly for you is the pie chart at the bottom, and the UCITS version of our global stock fund, which now has about $7 billion in assets. On the next slide, you can see our investment team. We'll touch just quickly on this because really it's at the heart of what we do. The column in the middle is all of our global industry analysts, and that is how the investment team is organized. We have analysts who follow industries on a global basis. They're out talking to company management teams, reading reports, finding investment ideas, and then advocating those ideas to the investment committees on the left-hand side of the page, which function as the portfolio managers for their funds. The third group down there, the Global Equity Investment Committee, is the group of 5 people who manage our global stock fund. We've included on the right-hand side of the page our fixed income team because we do work very closely together with them. It's, I think, one of the hallmarks of our investment approach. On slide 7, we've laid out the key points of our equity investment philosophy, which I'll just touch on because they really give, I think, a good understanding of how we've built our portfolio and what we've invested in. So to start with, it is a research-intensive process based on that team of analysts you saw on the prior page. Rough rule of thumb, we think it takes an analyst something like 2 months of research to dig in and really understand a company and write a report and be able to explain that business to the rest of the team. And so the analysts do that by, as we said, going out, visiting companies, talking to management teams, talking to competitors, customers, suppliers, consultants, physicians, whoever can help us get a better understanding of how a company got to where it is today and what its key challenges are going forward. We also do a lot of reading, company filings, presentations, industry trade rags, etc., all trying to just make sure that we understand a business and its nuances as well as we can. We then try to turn that understanding into a financial model, looking out 4 to 5 years at all of the key items. We model out a range of different scenarios, so not just the base case of what we think is likely to happen, but also an upside case of what does it mean for the company and what does it mean for us as investors if key items go really well for the company, and then more importantly, a downside case of what does it mean if things work out poorly for the company on some key variables. What we have learned over time through a lot of painful experience is that no matter how beautiful our spreadsheet is and no matter how many scenarios we run, the future never works out exactly the way we thought it would. The range of outcomes is always wider than we expect. Unplanned events happen. And so the one thing we really can know is the valuation of the company when we go in. And so price discipline is a very important part of our process. It's easier to beat low expectations than high expectations. And so what we're really looking for is not just good companies, but good companies that are in some way misunderstood and therefore good businesses. And we'll talk a little bit, good investments. And we'll talk about that a little bit more in a moment. The long-term view is a key part of our investment process. So we do look out 4 to 5 years in making our investment decisions. Typical turnover in the fund has been around 20% a year. And so our actual holding periods are 5 years or longer. I think that's increasingly unusual in today's investing world. And so it does really differentiate our fund and what we're doing from many of our competitors. There are lots of smart, hardworking people in the investment business. And so trying to do the same thing that everyone else is doing and expecting better results is very difficult. But really what we're doing is something quite different. Because share prices are increasingly set on the outlook over the next 6 to 12 months. And so if we're looking at 4 to 5 years, we're looking at a different set of variables and a different set of conditions. And so if you put together that focus on deep company knowledge, the focus on valuation and the long-term view, what you get is a portfolio with many companies where we think there's a very sound underlying business, but it's going through some sort of problems, issues, challenges in the short term. And so rarely do you get a good company at a low price unless there's something going wrong. And so our job is figuring out where those things that are going wrong can change or be fixed and where they're more lasting secular problems. And then lastly, we do focus a lot on risk, both at the individual company level. And so thinking about the balance sheet, the access to capital, sources of liquidity if the company needs it. Essentially, if things work out badly for the company, do they have the resources to see things through and take another try? Or is this really their one last chance and they need to get things right? And then also thinking about risk at the portfolio level. So the diversification, not just by industry or by sector, but also by underlying factors and what the exposures are in the funds to currencies, commodities, interest rates, and so forth. Maybe trying to put that a little bit more directly into the stock selection process. The key point on this slide is really the box on the top right, the internal characteristics of the company. And so that's where we spend most of our time. And so that's where the analysts are spending their time digging in, really trying to understand industries and businesses. And that's where our investment committees are spending time making sure that we understand what we're investing in and pushing the analysts on their assumptions and their views to make sure that as a group, we've really thought through them all and understand all of the risks. The external environment is obviously very important. We are not macro investors. We don't think we have any particular skill at forecasting economic growth or interest rates or other key variables going forward. And so we don't use that as a driver in our investment decision-making process. But we do recognize how important the external environment at both the industry level and the economy level can be for a company. And so we do try to make sure that we understand how that's influencing the current level of profitability at a company, and therefore what the profits are likely to be going forward. So our current earnings very depressed or very elevated as a result of external factors, and therefore what is the true underlying or normalized level of earnings at the business that we're looking to buy. And then lastly, on the left, company valuation. There's no science to that, and so no hard numbers that we're looking at. If we only buy a company with a PE of less than X or a dividend yield of more than Y, but it's really trying to understand what are other investors' expectations for this business and how might they be different from our own. And so again, a good company is not necessarily a good investment, and so we're really looking for that dislocation or that divergence between what we think a company is worth and what the market thinks a company is worth. And how big is that gap? How has that changed over time? And how does it compare to other things that we might invest in? The things we're looking for in a company, I think, are probably similar to what other investors are looking for. So we love businesses with strong moats that are deeply embedded in their customers, that are a small part of the customer's cost structure, that earn high returns on capital, that generate lots of free cash flow, and that send that free cash flow back to shareholders. And so that, I think, set of things we're looking for is similar to other people. The difference probably is our focus on how is that misunderstood by the market, or how is that not reflected in valuation, and by thinking about it more over a 4 to 5 year time horizon, as opposed to what are the earnings or the cash flows over the next 12 months. Everyone is looking for the perfect story of a great company in a great environment with a wonderful management team and trading at a low valuation. Obviously, you rarely get that. And so, as we said, our side of the trade-off is typically to take companies that we think are a good business, but have some real issues in the short term that gives us a chance for a low valuation. We do then have a fairly detailed process of how we bring those ideas forward and test all of our assumptions. I won't obviously read everything on this page, but we'll just say things start with the analyst on the left-hand side, they end with the investment committee on the right-hand side, which is, again, the portfolio manager for the fund making the decisions. In the middle is a detailed underwriting process that we go through, where we spend hours debating and discussing and digging into all of our investment ideas. This process works well because we do invest with such a long time horizon. And so if you're going to own a company for 5 or 10 years, it's worthwhile to spend maybe a few extra weeks up front making sure you really understand it well. It's also important because we are often investing in troubled businesses, and it's important that we really understand the risks that we're taking on in the portfolio. Maybe moving to slides 11 and 12, I'll talk a little bit about the opportunities that we see in the market. The first is on valuations. And so clearly the market is not cheap, and we'll talk about that a little bit more in a moment. but we do see parts of the market that are quite a bit cheaper than others. And so the first of those is looking at value stocks versus growth stocks globally. Obviously, growth stocks are always going to be more expensive than value stocks, but that value gap is quite wide now. And so, as you can see in the top left, in 2023 and 2024 were wonderful years to be a growth investor and quite challenging for value investors. 2025, things sort of evened out, but the gap in valuations that you see in the bottom left has not narrowed very much. And so the chart on the bottom right there is just looking at how wide is that gap relative to how it's been in the past. And you can see it has narrowed a little bit over the past year, but that value gap is still quite wide. And so that historically has been a good predictor of performance for cheaper stocks. So no surprise when the gap in value between cheap and expensive stocks is quite wide, cheap stocks often do well going forward. And so our process is always, again, looking at trying to find good companies at low valuations, but when the valuation gap is this wide, the focus on valuation comes in a little bit more. The second gap in markets that we see is that international stocks are still cheap relative to US stocks. So this is something that we've been talking about for a while. 2025 was certainly a great year for investing outside of the US. And you can see in the top left, 32% returns for the ACWI ex-US benchmark. So a wonderful year for investing outside of the US. Not that it was a bad year in the US, but even better outside the US. But again, because the gaps were so wide to start, there's still quite a large gap. And so you can see down in the bottom left, we're in about the 84th percentile in terms of how cheap international markets are relative to US. So not quite as cheap as we were 12 months ago, but still we think there's a lot more opportunities to find misunderstood or misvalued businesses outside the US rather than inside the US. This is all within a context of markets that are quite expensive overall. And so on slide 13, we looked at how expensive different benchmarks are around the world. And so geographically, there's not very much escape. Markets are expensive everywhere in the world. It's also true on slide 14, as you look by industry, almost all industries are very expensive. And so in thinking about what we're concerned about in 2026, I think this would be at the top of the list, is that markets are quite expensive as we go into the year. And so that will be a headwind. Historically, there's been not a lot of correlation between valuations and short-term market returns. And so it may not be an important factor in 2026, but longer-term returns are certainly affected by the starting valuation level. And so as we think about what returns we might expect from the market over the next 5 to 10 years, the high starting valuation levels are certainly a headwind. Last year, both of those things that we're talking about, international outperforming US and value doing a little bit better than growth, can kind of be combined in looking at this slide, which looks at countries by their starting valuation level and how well they performed. And you can see, broadly speaking, more expensive markets like the US and India underperformed cheaper markets like South Africa and Korea. In thinking about things that have worked well for our fund, one of the biggest ones has been European banks. And I think it's an interesting example of our investing process because it shows the patience and persistence that is sometimes necessary. And so we've been invested in European banks for a while, largely driven by the extraordinarily low valuations. And so some of our key European bank holdings like Santander, BNP Paribas, Barclays have been trading at mid-single digit PEs. And those are PEs on depressed earnings, which means price to book has been 40%, 50% of book. So extraordinarily low valuations. For some time, the businesses were continuing to do poorly, and so the valuations didn't improve. We saw that as an opportunity to add to our positions at sometimes even lower prices than we started. And then last year, finally, things started to come together. Higher interest rates in Europe and a stabilizing economy led to expanding net interest margins and rising profits, which was then reflected in rising valuations and fantastic performance from many of our bank holdings, which then led to us gradually trimming back and selling many of our positions in both European and US banks. Again, we do love cheap companies and we care a lot about valuation, but we also care a lot about the quality of the business. and the gap between our expectations and that of the market. And so at 40% of book, it was clear that we thought these banks were undervalued. As the valuations have approached book value, it's harder to see the misvaluation. And so we have been moving on to other opportunities. And I think that maybe is a good chance to talk more broadly about the opportunities that we're seeing. And so you can see some of them here on page 17. And so unfortunately, because finance was an area of big trims for us last year, we don't mention some of the things we're buying, but I think that's actually quite interesting and reflective of what we see in the market today. And so maybe to take a step back, the two big factors driving markets last year, I think, were AI, which we'll talk about in a moment, and increasing optimism about economic growth, or at least avoiding recession. And so we saw cyclicals like European banks doing very well. We saw AI-driven companies in technology doing very well, and many other things doing quite poorly because they were not part of those themes. And so within finance, one of the interesting examples of that is the insurance brokerages. So Aon, Willis Towers Watson, and Marsh McLennan being the three big ones. These are great businesses. They are very capital light. They're essentially advisory businesses, but they're deeply embedded with their customers. They've historically earned wonderful returns and grown steadily across a range of different economic and insurance pricing environments. So many of the hallmarks of a classic excellent business. We have not owned them because they've been very expensive. And so great business that everyone appreciated as a great business. And so we didn't see an opportunity there. And instead, we owned things like Barclays or Wells Fargo. As the valuations on those more cyclical credit-sensitive banks rose last year, the valuations declined quite considerably on the insurance brokerages. And so if the credit-sensitive banks are 8 times earnings and the insurance brokerages are 24, then we own the lower quality credit-sensitive banks. As the valuations have converged and the difference is maybe 12 times earnings versus 16, then we'd rather pay a premium and own the much better business with better growth prospects and less cyclicality. And so as we had sold companies like Barclays and UBS and Bank of New York, we started positions in Aon and Willis Towers Watson. We also started a position in a bank called Julius Baer in Switzerland, which is one of the leading global wealth management banks. And so that's a business that other banks are all trying to get into because it earns much better returns on capital with less capital requirements and lower risk than other parts of the banking business. And it's essentially 100% of Julius Baer's business. It's a company that has had some struggles in the past, and so sort of fits that Dodge & Cox definition of a high quality underlying business that has had some management issues and some challenges it faces, which have reduced the valuation. But we think over a 3 to 5 year period, those issues can be worked through, and the underlying quality of the business should show through. Other big area of opportunity that we saw last year was in healthcare. And so pretty much a terrible year across the board for healthcare. All of the different parts of healthcare struggled last year. In healthcare services, which is largely health insurance companies in the US, there were underwriting problems combined with regulatory issues. They caused earnings for the business to drop sharply, in fact, to go negative in the core insurance business for many of the companies. We think health insurance in the US is also an excellent business. Over the long term, it has been consolidating. It has real economies of scale, has earned high returns on capital, has generated lots of free cash flow. We think in the future it will continue to be a good business. And because today the valuations are very depressed because there are real short-term issues, we thought that was an interesting opportunity. And so we added significantly to holdings like Cigna and United Health. In 2024, we had added very significantly to CVS, which is another of the large health insurance companies that has started to work through its problems and roughly doubled during 2025 and was one of our top contributors during the year. And then on the pharma side, there was quite a bit of turmoil in 2025 from the Trump administration, discussions of most favored nation pricing, essentially trying to reduce U.S. drug prices to international levels. turmoil at the FDA, fears about drug approval, vaccine approval. All of this led pharma stocks to be under a fair amount of pressure during the first half of 2025. We thought that was, again, an opportunity to own good businesses at lower prices. And so you can see we added to our holdings in Regeneron, started a new position in BioNTech. Those are both founder-led, science-led companies with a great track record of innovation. And we think they will continue to innovate. And so being able to buy them at a low price was a great opportunity. Then the last thing I'll talk about on the right-hand side is information technology. So we have been quite underweight in IT. Given the high valuations in the sector, it's been hard for us to find businesses that are not well appreciated by other investors. But last year we did find two. And so TSMC, a company I'm sure you're all familiar with, Taiwan Semiconductor, really the bedrock of the global semiconductor industry. It's the leading foundry company making chips for other people. Historically, that has been an oligopoly business. It has increasingly become a monopoly business at the leading nodes. The most advanced chips really can only be made now by TSMC. And so they have enormous pricing power and enormous stability to their business that we think is not appreciated in the price. And so as we look at the valuations across the semiconductor industry, TSMC trades at a massive discount to the valuations of its customers. And so companies like NVIDIA, AMD, Apple all trade at much higher valuations than TSMC, but they all rely on TSMC. And so we think that may be because the company is located in Taiwan and people are concerned about the geopolitical risk. But frankly, if something happens in Taiwan to TSMC, then none of their customers will be able to sell products either. And so you're taking on that risk, whether you buy NVIDIA or whether you buy TSMC. But at TSMC, you're getting paid for that risk, and it seems like at some of the other ones, you're not. And so that's a position we started in 2024 and then added to significantly during 2025. Similarly, SK Hynix is one of the three leading memory chip makers. And so memory is an essential part of pretty much everything within technology, but most importantly, in AI data centers, memory chips have to be paired with the GPUs or ASIC chips that power the data centers. And that actually is increasing quite a bit. And so each new generation of GPUs uses more memory relative to the processing power than the prior generation. As we move from GPUs to ASIC, that also uses much more memory. And so as stunning as the growth of NVIDIA and other makers of GPUs has been, the growth in memory demand is even faster. Despite that, at the beginning of last year, or even the middle of last year, SK Hynix was trading at about 6 times earnings. And so you could see there was some substantial fear that AI was going to roll over and maybe that the boom was very short lasting. At the same time that other companies in the technology space exposed to the same underlying factors were trading at 30 or 40 times earnings. So to us, that seemed like a disconnect, and we started a position in Hynix, which has obviously done quite well since then. So hopefully that gives a flavor for the sort of areas where we're finding opportunities and the type of stocks that to us seem like opportunities. Maybe I'll just touch quickly on our US weight because it has been a growing difference from the benchmarks. Our fund has been roughly 50% invested in the US since it started in 2008. But as you can see here on the chart on the left, and as I'm sure you already know, the US weight and global benchmarks has been rising steadily and quite substantially, mostly driven by the increase in valuation for the Mag 7. And so for us in our investment view of the world, rising valuations don't make things more attractive. And so the fact that rising valuations in the US have made it a bigger part of the benchmark don't lead us to invest more in the US. And so our underweight to the US has grown pretty considerably over time. And we're now about 15 percentage points underweight in the US, mostly due to our underweight within the Mag 7. Maybe I'll end here with just a look at how our portfolio is positioned today. And so across the top, the bars there are the global stock fund compared to the ACWI benchmark and the ACWI value benchmark. You can see we're quite large in financials, quite large and quite overweight in healthcare, and then underweight within information technology in the middle of the page. Again, that's mostly driven by valuations. Then on the bottom right, as we discussed, we're underweight in the United States, and conversely, overweight parts of the world where valuations are lower, and companies have done less well. And so that's particularly in Europe and emerging markets and the UK. The last thing I'll point out on the bottom left is looking at the characteristics of the fund, and particularly the valuation characteristics across a range of different measures. You can see we are quite a bit cheaper than the benchmarks. And so as you look at our largest holdings, companies like TSMC or Alphabet maybe don't stand out as being obvious value stocks, but I think that valuation discipline does show through in the at the portfolio level as you look at the range of different measures there where we're cheaper both relative to the equity benchmark and even relative to the value benchmark. So maybe I'll stop there.